All right, so let's take a look at some of the Chapter 8 textbook exercises. So we're going to look at, this one is going to be exercise 8-8, and let's take a look at what they want us to do. So notice they want the November adjusting entry for bad debts. That'll be the first requirement. And then the second one is they're going to talk about they started in December, they switched to an aging approach, and then they give you what their accounts receivable was at the end of the year, and they give you the aging. So we're going to apply some percentages to come up with our estimate. And then it'll say before the year in adjusting entry, we want to know the allowance account has a 1,000 credit balance. So we'll need that to make our adjusting entry, because we always have to consider what the current balance is in the allowance account. So we'll need that. And then we'll show the various accounts are related to the accounts receivable that they are showing it on the balance sheet. All right. So first up, let's check out. So in this case, they are estimating, it says it up here, I know you can't read it, but they're going to estimate that 1% of their November credit sales would be going bad. So if they took 1% of 78,000, that would give them an estimate of $780. And of course, your adjusting entry would be simply debit bad debts expense and credit the allowance for doubtful accounts. And remember, under this approach, this is the credit sales method, or the income statement method. Remember, to get your adjusting entry, all you do is take the percent times the credit sales. You don't have to worry about the balance in the allowance account, okay? So this one's pretty easy. You just debit bad debt expense and then credit the allowance account. And that's how you do that adjusting entry. Okay, now, once they switch to the aging approach, remember, you have to apply percentages or probabilities depending on how old the receivable is. So you've got 1 to 30 days, 31 to 90, and then over 90. Now up here, they give you the percentages, and I know you can't read that, but it's going to be 5% within the first 30 days that those accounts receivable would be bad. And then the next 31 to 90 days, 10% would go bad. And then over 90, they're estimating that there's a 20% probability that those receivables would be bad. So all you do is you take these percentages, multiply them by each category, 5% times 21,000, 10% times 15, and so forth. And then once you get these bottom numbers, you simply add them up, and then that's going to be your estimate. Now, before we get to the adjustment, what I always do, at least in my classes, is I like to draw the T account. So if I do the T account, and again, we're talking about the allowance, I'll just write allowance, the allowance for bad debts. Remember, this estimate, that would be your desired ending balance, okay? Your desired ending balance is $3,550. So that's the number you want to be the ending balance for your allowance account. So you have to take into consideration, before you do any adjustments, if you have any amounts in your allowance account, because that's going to affect how you get to that ending balance. So that's typically the aging approach. So let's go to the next slide. And of course, here's what they show you. They say, let's assume that the allowance account had a credit balance of 1,000, and we want that desired balance to be $3,550. So the difference, which is kind of like your plug number, would be $2,550. So you debit bad debts expense and credit your allowance account for that plug number to be $2,550. And the reason you're doing that is because this adjustment allows that allowance account to get to the desired ending balance. Okay, now on your balance sheet, let's go back. So $3,550 is your allowance account. So on your balance sheet, and again, the numbers came in kind of crazy here, but this number right here, again, that is $3,550 from the previous slide. So you notice that this number right here, if you take your accounts receivable, which is 41,000, subtract out your allowance, again, this is the allowance account, which is $3,550, you get what's called, I call it your NRV, which is your net value. They call it accounts receivable net of allowance. This is the number that would show up on the balance sheet as simply your net receivable. All right, next exercise. This is 8-13. And on this one, they give us a couple scenarios. You'll notice we've got year 2 and year 1 back to back. They give us our accounts receivable net of allowance. So these are your net receivables. These are your net revenues. And then it says, according to the 10K, they recorded bad debts expense of $840 and did not recover any previously written off accounts during the year ended December 31st, year 2. So on the requirements, they want to know what amount of accounts receivable was written off during the year ended December 31st, year 2. And then they want to know the turnover ratio. And then part 3 says, does your answer in requirement 2 suggest the collectability of accounts receivable improved or deteriorated in year 2 relative to year 1 when the turnover ratio was 4.8? So they want you to do essentially some analysis in terms of interpreting those ratios. All right, so let's take the first part in terms of your allowance. So you'll notice all they do is you set up your T account for your allowance, and notice you've got a beginning balance which was $6,700 and an ending balance which was $5,500. And if they had a bad debts expense of $840, notice that would have been credited to your allowance account. So this number right here, essentially when you write off, remember when you write off an accounts receivable, you would be debiting allowance. So notice that is simply would be, again, a plug number. Now, again, since you kind of already had the T account written up, again, I would do it again. So if I, again, wrote this out, again, it's pretty much the same as they would do it. Now you draw your allowance again, and you'd start again. You say, okay, what's my beginning balance? 6,700. What's my ending balance? Remember, that's your desired balance. That's 5,500. That's what was given. And so they told you that they did an estimate, and that 840 was the estimate that they wrote off, or that they booked for their adjusting entry. And so basically, to get from 6,700 to 5,500, there had to have been a number in your debits, and that's the plug number. And again, that's how they're doing that. And then they're showing you the calculation right there. So that's how they come up with that number in terms of what they wrote off. All right. So on the next slide, it's just your turnover ratio. And you'll note that, again, it's your net receivable. So your denominator is 164 plus 126 divided by 2. I know you can't see that here, but it's 164 plus 126 divided by 2. And of course, it's your net revenues divided by that, your average receivables. You got 5.7. And of course, that's a higher turnover ratio. That's good. So therefore, that would be better. You're collecting your receivables faster than in year 1. All right. Next exercise is 814. And on this one, it looks like they're wanting you to determine the bad debts expense for year 2 based on the above facts. So you got accounts receivable in your allowance and your net receivables. Assume that the accounts receivables write-offs amounted to 7 during year 1 and 9 during year 2, and that they did not record any recoveries. Okay, so they want you to figure what the bad debts expense, determine the bad debts expense for year 2 based on these above facts. So the next slide, you'll notice we like to go back to our T accounts, and you'll notice what they give us here from year 1. That would be your starting point. That's your beginning balance. Year 2 says ending balance was 36. And if they said they had some write-offs, so part D, you've got 13. That, of course, is what your estimate would be. But if you go from 32 to 36, and they told you, they gave you that they wrote off 9, so that would have been the number they gave you. The 13 then would simply have been kind of like, you know, a plug number to get your bad debts expense. All right, so again, the way this thing has to work out is, again, there's your write-off of 9, so you know you would have debited it. You had the beginning balance of 32, and they gave you the ending balance of 36. They did not give you this number, which would have been your bad debts expense. So that 13 simply would have been a plug number. This 7 is actually irrelevant because we're actually dealing with year 2. All right, next one, 816. So again, on this one, they just want us to do our ratios. They want the receivable ratio, turnover ratio, and then do the, compare it to year 1. So looking at our calculations, notice again, So we've got our average receivables, 4,231.80 divided by 2, that's your denominator. Your net sales in year 2 was 34,430. Divide that by your average receivables, you get 9.3. Then you take 365, divide by that, tells you're collecting receivables about every 39.2 days. And then part 2, it says in part 1, you're comparing it to year 1. Well, year 1, the turnover was 7.6. In year 2, it's 9.3. So therefore, they are collecting the receivables faster because that number is higher.